Robert Levitt, who's the Chief Investment Officer of Levitt Capital Management, joins us from Hong Kong. Morning, Robert. Good to have you with us on Morning Mantra. Let's first start off by getting your perspective on India versus China. Both the countries stacked up against each other in the world of BRICS. Now, which one do you prefer more?
Well, look, I actually spend about half my time in Asia and half my time in Europe, even though our firm is located in the U.S. But the problem now is that a lot of money that would have gone to emerging markets, I think, is going to go back to the United States. I mean, not necessarily a problem, but it's a problem for emerging markets because they've really benefited as the S&P in the U.S. went nowhere for so long, and now the U.S. I think is becoming much more competitive because of the low-cost energy. Their massive move to get off of gasoline completely, which is real big change, to go on to natural gas as a transportation fuel, and so you're seeing the U.S. become the second most competitive market for petrochemicals, and that's going to bring industry back to the United States. And so if there are a lot of investment opportunities in the United States, there will be less money that will be leaving the U.S. and going to emerging markets. But I think China still is a much more interesting place than India. India continues to have a lot of internal issues that they have to work out first, where China is much more focused on outside of China, and they're working on improving the cost for commodities. They're getting involved in buying commodities, but they're not doing it in the traditional way where you have to make money. They're doing it in the way where they can get supply, they can try to drive down the cost. So everything China's doing is going to try to drive down the cost of commodities. India in some ways is really caught. They're in that Indian Ocean area, which should be fantastic for them, but they haven't really been able to get out of their own way. They're still, India is a very challenging place. They're moving on a snail's pace, but they're in an interesting part of the world. There's certainly lots of opportunities, and we'll have to see what they do to take advantage of their particular advantages.
Right. So, Robert, if you talk about India specifically, the start of the year was a very good one for the country. And do you believe that, the liquidity flows will continue to drive the markets higher despite the political and economic risks that we see here?
I think that the liquidity is going to slow down. I mean, it's going to slow down. I mean, the U.S. has said, no, we're not going to do QE3. I don't know. Whether they do it or not or some other form is to be determined. Also, in Europe, they said this is the last LTRO that they just came out with. And liquidity has been a real important driver. But if liquidity doesn't continue, if the U.S. doesn't expand its money supply where that money is going all over the world, it won't help the emerging markets. And so with China and with the trade deficit both ways, reduced on both sides, more balance, I think that's not going to be the most positive thing for emerging markets. But, look, these things change all the time. You have to look at a little bit of a longer-term viewpoint right now. You have to focus on where the competitive points lie. And even in Europe, it just seems to be in such a quagmire from a competitive point of view. There are some interesting things happening on the ground. Each country is trying their best to become as competitive as they can. So it's very difficult to look out and say, look, over the next 5 years, it's going to be in the U.S. But if the U.S. does perform, there's a lot more people that feel a lot more comfortable having money invested in the U.S. than they do investing in emerging markets. So I think that could be a change into the U.S. that we haven't seen for a long, long time, for many, many years.
Robert, what according to you is a bigger risk in India in the near to medium term? A poor balance sheet and lack of reforms, or the politics where the government is losing its ground?
Well, I think in both. I mean, we're frustrated as investors because we're not allowed to invest in individual stocks in India. And about a year and a half ago, I went to India. I met with the head of their Securities Exchange Commission, and he said, look, you're the kind of firm we want. You'll disclose who your clients are, but right now our regulations just aren't set up to allow investors like you to come in. So, that's a problem. When you don't allow foreign investors to come in because the regulations aren't set up, you've got to change it. Because India needs to have money coming in from all over the world. But when you prohibit people, okay, they came out a few months ago and said, look, we're going to change the rules. We're going to allow foreign investors to come in like us, where we're representing, wealthy individual investors around the world. And yet then they did nothing to disclose the rules. So we don't know how to do it. So as long as, India they need to focus, they need to get these things done. And, it takes time. There's a lot of other issues. There are a lot of political issues that are going on right now. And so all good things in time, but right now our money is not going into the Indian, in any economy or the Indian equity markets. And I also think India is also one of those countries that's really troubled by the high cost of oil. Oil prices are going down in the U.S. In the center of the U.S., they're paying $84 a barrel for crude. West Texas is a little over 105, 106, whereas Brent is 125 plus, and that's what India has to pay. So India is got some disadvantages, and the faster they can put everything together. But look, it's a big country. They've got a lot of things to do, and that takes time, and so we have to be patient.